Welcome back to my channel where we are going to be financially smart together. Now, this is a basics to options series. And in this video, you're going to learn what is an option, how to read an option, and what does it mean to buy and sell a call and put option. Now, this is a pretty good video to bookmark and review because in the beginning phases of your trading, it's so easy to get these concepts mixed up. And make sure to watch to the end because this video is the very fundamental that you need to understand in order to understand the more complex concepts around options. You can buy options on many things like stocks, indexes, commodities, etc. But for now, when I talk about options, I'm referring to stock options. And just keep in mind that options are unlike stocks and that options decline in value over time. So you can think of stocks like real estate, because real estate maintains its value depending on the market condition. And you can think of options like cars. When you buy a car, it declines in value over time. One option contract involves buying or selling 100 shares of the underlying stock that the option is related to. So on trading platforms, these options are quoted on a per share basis. So you need to multiply what you see by 100 to get the actual premium of this option contract. There's 4 components that makes up an option: the underlying stock, the expiration date, the strike price, and whether it's a call or put option. A call option lets you buy 100 shares of the underlying stock at the strike price on or before the expiration date. A put option lets you sell 100 shares of the underlying stock at the strike price on or before the expiration date. So if you have an ABC March 12, 20 call option sold at a price of $2, then the option is the right to buy ABC on or before March 12 for $20 per share for a premium of $200 because it costs $2 per share times 100 shares. If it's an ABC March 12, 20 put sold at a price of $2, then the option is a right to sell ABC on or before March 12 for $20 per share for a premium of $200. There's 4 things you can do with options. You can buy a call option, sell a call option, buy a put option, or sell a put option. Now, for the next portion, please write this down or take a screenshot. When you buy a call option, you're expecting the stock price to go up. When you buy a put option, you're expecting the stock price to go down. When you sell a call option, you're expecting the stock price to go down or move sideways. When you sell a put option, you're expecting the stock to go up or move sideways. So an easy way to think about this is that you can think of buying a call option similar to buying a stock, in that when you buy a call option, you want the stock price to go up. And you can think of buying a put option similar but not the same as shorting a stock, in that you want the stock price to go down. For you to be able to buy an option, there must be someone willing to sell you that option. So in other words, for every buyer, there must be a seller. Now, to see what happens when you sell a call option, let's use the same ABC March 12, 20 call example. When the person who bought this call option exercises the right to buy, the option seller must sell 100 shares of ABC at $20 per share as long as it's on or before March 12th. In other words, the option seller will give 100 shares of ABC to the option buyer, who would in return give $2,000 to the option seller. Now let's see what happens when you sell a put option. In the same ABC March 12, 20 put option example, when the person who bought this put option exercises the right to sell, the option seller must buy 100 shares of ABC at $20 as long as it's on or before March 12th. In other words, the option seller will receive 100 shares of ABC stock and give the option buyer $2,000. Feel free to review this video as many times as you need to understand the concept, and put any questions you have in the comment section below. And now that we have the basic definition down, check out the video where I explain how to calculate profit, loss, and break-even points. And remember to subscribe and hit the notification bell so you won't miss out on any future lessons like this.